ICT, e-banking and firm performance. Introduction. ICT is concerned with storing, retrieving, manipulating, and transmitting digital data. ICT involves software, hardware, and systems. In an age dominated by computers, digital data has become integral to business performance. This presentation focuses on one component of ICT, e-banking, and its impact on business performance. E-banking. Definition. E-banking involves the delivery of banking products and services to customers via digital channels. Customers do not have to physically visit banks since services are delivered through computer-controlled systems. The examples of e-banking services are credit and debit cards, automated teller machines, electronic funds transfer systems, EFT, mobile and internet banking. Factors favoring the development of e-banking. The increased use of computers and the internet across all generations greatly affects the decision to use e-banking services. Another factor in favor of e-banking is the elimination of set banking hours. E-banking is flexible, customers can transact at any time. Last but not least, it is cheaper. Advantages of e-banking. Convenience. Banking services are not tied to location. People can transact with their banks from anywhere in the world. Cost advantage. E-banking costs less than physical/over-the-counter banking. For example, ATM withdrawals are charged a fraction of over-the-counter withdrawal charges. Time saving. Queues and other delaying factors in physical banks are eliminated, hence making service delivery faster. Reduced errors. Computers are less prone to errors than human cashiers. Disadvantages and risks. The main disadvantage is a lack of personal touch in service delivery. Another one is a security risk. Online fraud can result when unauthorized persons transact using customers' accounts. Besides, there is a risk of network failures. E-banking is prone to internet failures, disrupting or delaying important transactions. Impact on business performance. Efficiency of EFT enables businesses to pay suppliers promptly, thus increasing their satisfaction and supply chain efficiency. Reduced banking transaction costs result in increased profits for the businesses. Improved financial management is when businesses can monitor their banking transactions and impact cash flow position in real time. Previously, they had to wait for bank statements. Lowering entry barriers in the banking industry proposed traditional banks with wide branch networks so they are exposed to competition from new entrants. Increased supply chain efficiency reduces supply chain costs. Real-time information improves financial decision-making. With e-banking, new entrants do not require extensive premises to meet customer needs. They can operate with smaller premises and invest more in ICT. New entrants into the banking industry also force current payers to be innovative or lose out on their customer base. The numbers say that 73% of respondents prefer to interact with their bank online rather than physically, and 64% of e-bankers pay bills online. In 2009, the figure was 19%. Banks estimate that e-bankers are 15% more profitable than over-the-counter customers. Conclusion. Firms need to adopt e-banking in order to save costs, improve efficiency, and maintain competitive advantage. The major risk associated with e-banking is security. Firms need to ensure they invest in the security of their transactions to avoid losses.